Today we will analyze the portfolio of a subscriber and we will see right away if this person has understood what we teach on this YouTube channel. Long-term proper investing. So we have a message from Abersa. Hello Christophe, great information about evolution. What do you think about my portfolio? Lastly, I restructured it and closed some positions. Some advice to give me. I have more than 1 year in the market. Thanks in advance for the help. So we are here on eToro. Let's check his eToro website and we will see portfolio. Okay, here we go. This is the portfolio. Let me get my face here. Maybe that will be clearer for you. Okay, this is the portfolio. You know what? Let's check every one of the positions, all the positions, and you will have my opinion on it. And from what I see, you have a big concentration in Evolution AB, that's 10% of the portfolio, and then some European names, LVMH, Nestle, Oxy, Google, Lululemon. Yeah, seems like you are on Twitter right now. All the famous names you see on Twitter. You have some Stellantis, some Bitcoin Cash, some Monster Beverage, and some Sociedad Química de Minera de Chile. I have no clue what this is, but okay. Now let's start from the beginning. You asked for a complete review of your portfolio. You will get it. The first position is Evolution AB. You can check the financials of Evolution for yourself, but I know the stock really well. I owned it and I have a strong conviction in this stock. The Evolution company is in the online gambling industry, so they sell online casino games to other casinos and they are clearly the leader. They have spectacular margins. They have been growing very fast. They went public in 2015, so almost 10 years of being public, and I'm on Guru Focus right now. The market cap of Evolution is 20 billion, so this is not a small cap, this is a mid cap. The margins are completely spectacular, like 50% free cash flow margin. Return on invested capital is really high, and if you look at the growth of revenue in blue and net income in green, this is some spectacular number actually. This is some spectacular growth that they have had. The company has a pristine balance sheet with almost zero debt and a lot of cash, a growing cash pile, and they generate a lot of free cash flow. So that's 10 out of 10 for me. If this investor invests for the long term, I believe Evolution will be a great investment for the future, for the next 3 years, 5 years, 10 years. So they have some short-term problem about growth, short-term strikes, short-term problems, and that is the reason why the stock is trading at a low valuation. You have a PE of 17, so that's at the low end of valuation, and I think the stock has never been trading cheaper in terms of PE ratio. So they have some temporary issues with some new taxes, strikes, temporary hiccups, some growth in North America that is recent, really new. So a lot of uncertainty in the market, but still the stock is generating a lot of cash, a lot of good growth, and management is good, and the runway for this stock is amazing. The potential for this stock is amazing. So you have, if I remember correctly, a little bit more than 10% of your portfolio on Evolution. That's a solid 10 out of 10 for me. 11% of your portfolio to these kind of investments will do a good job at lifting your portfolio for the long term. Okay, the second stock here is LVMH. I'm French, so I know the stock really well, and everybody knows the Louis Vuitton bags. So, you know what? Let me just put my face here. This is a solid company. We are not talking about the same kind of growth compared to Evolution, but still, this is a solid company. It's a big company. We are talking about a market cap of $400 billion, so really big company, and you see some temporary setback caused by China because they sell a lot of their bags, a lot of their products in China, and because China is in the recovery phase, is not in the booming phase, they don't buy a lot of their stuff, and that is the reason why revenue has been decreasing or net income has been decreasing. I don't follow Louis Vuitton very much actually. I just look at it far away, so I'm not an expert on the stock, but obviously this is a luxury company, so gross margins are really high, operating margins quite high, net margin quite high, free cash flow margin completely decent, return on invested capital 10%, 20%. So we are talking about a solid company with good efficiency, and now the PE ratio is at 23. That could be quite cheap if you think the company will continue to grow profitably in the future. And if you look at the growth, now we are not talking about evolution. You don't see some exponential growth. If you look at the revenue, over the past 10 years, they went from 35 billion of revenue to 90, so almost a triple. Net income has been following the same trend, up and to the right, so that's really decent. I would be curious to see what happened here in 2015 and here in 2020. What caused the decline in net income? Because, I mean, lockdown can prevent you from buying bags maybe. And they have some debt here. They have about net debt of 30 billion, so they have a lot of leverage, but this is okay. The market cap is 400 billion, so in percentage terms, the debt is not extremely big. And they generate strong free cash flow over the years. Yeah, you see some short-term problems here recently, but over the past 10 years, they generated more cash flow and more cash flow, more cash flow. This is what you want to see. And you have an improving return on invested capital, but yeah, it's about 15%. It's a really, really decent pick, good company, and maybe in 5 years, 10 years, the company will be better. The main risk I will see for Louis Vuitton is either the CEO disappears for some reason, or the CEO is too old. Bernard Arnault was supposed to step down as a CEO, but shareholders, I think, voted, so he remains 5 years longer in the company. But what will happen after 5 years? If Bernard Arnault leaves the company, if the boss of Louis Vuitton leaves the company, who will be the next CEO? Who will be the next chairman? I don't know the governance of... this is a family-owned business, so maybe Bernard Arnault has, I don't know, 4 children, 5 children. So one of them will have to take the reign of this company, but I don't know the expertise of the children, the competency of the children. Fun fact, his daughter, Delphine, did the same business school that I did in France, EDEC. That's the fun fact for today, but I don't know the competency of the children actually. So yeah, they are all in the business, but the main risk I would see for Louis Vuitton actually is in 10 years, who will be the next CEO? And will that be a mess? Because if this is a mess, you can bet that other companies like Hermès in this industry will take advantage of the situation. So maybe this is the reason why the stock is also dropping. You have China, yes. You have some slowdown, and you have some worries about the governance, about the CEO. That's worrisome and completely understandable. I know some personal friends that don't invest in Louis Vuitton, especially for this reason. What will happen when the CEO retires? Because he is, I don't know what age, between 70 years old and 80 years old. So yeah, that's the end of the career. Maybe he wants to retire, so that would be a main risk. So this is not a 10 out of 10 stock, not at all, but that's a decent 7. But yeah, if I had some advice for you, Abersa, just look at the governance situation, CEO situation, and monitor China. This is some key things to monitor for this stock. Okay, next one. Okay, that was 5% of your portfolio. Now you have 4% of your portfolio, Nestle. I'm telling you, I don't like Nestle. So you know my point. I don't like Nestle. I think you have way better opportunities. I think this is some boring, safe stock for somebody who doesn't want to take any risk, but apparently you like the gambling industry because evolution is in your portfolio. So this is a mismatch of philosophy in your in your portfolio. This is maybe a hedge for you, but you can't have great results if you invest in Nestle. If you had invested in Nestle 10 years ago, the stock was 75, now it's at 100, so almost no growth in stock appreciation. And in terms of dividend, the dividend yield is 3%. So yeah, you would have underperformed almost all indices. The S&P 500 in revenue flat, net income flat over 10 years. That's a mess. Growing debt, that is not good. That is not good. Free cash flow, no growth at all, and return on invested capital at 10%, and not growing at all. So all I see is red flag for Nestle, and for my kind of investing, I don't like it at all. So they do some buybacks, 3% buybacks. So you have a dividend yield of 3%, a buyback yield of 2 to 3%, so maybe a 6% shareholder yield, and that's it. That's what you can get out of Nestle, 6%. Congrats. No, if you want, you can deserve more. You can have better results. The P ratio is around 20, so that's not expensive, but definitely not cheap for a business that is not growing at all. Oh yes, Nestle will be here in 20 years, but this is a business that is not growing at all, and the market cap is big. I don't know about their potential. I think you have taken advantage of the volatility, the short-term price movement, but just monitor what caused this slowdown. Because I'm looking at the big picture, and if you had to invest for the long term, 5 years, this is not a good bet. This is not a good bet at all. So this is a 1 out of 10 score for me. This is my opinion. And that's it. You can argue this is cheap because of X and Y reason, but you have other bets, especially in Switzerland. You can have other companies that are growing better than this. I don't like this stock at all. Okay, next one is Oxy. I own Oxy, so I know the stock really well. This is the favorite oil bet from Warren Buffett. So a lot of big investors have bought Occidental Petroleum. Lilu has bought some Occidental Petroleum a few months ago. Lilu is the best Chinese investor, and you have one of the best Canadian investor, Prem Watsa. One of his favorite position is Oxy. So you can say that a lot of big investors like Occidental Petroleum. What is wrong with Occidental Petroleum? Because the stock has gone nowhere. So this is not maybe no long-term bet. If you had invested 10 years before, you would have not made a lot of money. You would maybe have lost some money, but apparently they have some great future. So I hold a small position in Occidental. I follow it quite closely, and I would question their capital allocation, because this is an oil company. They drill oil, and they don't do a lot of capex, so exploration. So this is just pure cash flow generation. And they told us shareholders a few years ago that the main goal for capital allocation was buybacks and dividends, and that's it. And then 1 year later, they did a big acquisition fueled by debt. So that I didn't like, actually. Some distrust in management that I didn't like at all, actually. And now they want to reverse track and go back to dividends and buyback. But over the past 10 years, this has been a mess, and absolutely no growth over the past 10 years, but that's normal. That's the oil industry. This is a cyclical industry with a lot of debt, and they have been generated some good free cash flow in 2021, 2022 because of high oil prices. But now the situation is quite different with low oil prices. They still have some debt. They want to boost buybacks. And I'm not convinced, actually. So this is if you are an oil expert, yes, that could be good. If you believe Warren Buffett is right and you are a hardcore fan of Warren Buffett, maybe this is a good bet. But if you don't fall in these two situations, I would not recommend buying Occidental Petroleum, because you need a lot of faith to invest in oil stocks. This is a very, very difficult industry. Okay, next one is Google. I don't have to present Google. I don't have to introduce what Google does. This is one of the best opportunities in the moment, in my opinion. Okay, I have to do this again. And I have bought more Google recently. So this is, how do you say it? I walk the talk of saying, Google, I like it. A lot of cash flow generation. The stock price has been decreasing due to regulatory lawsuit. And I believe this is some short-term event that caused the recent stock decline, but fundamentally the business is still good. Some good margins, good revenue growth, good net income growth, a lot of cash, not a lot of debt, good free cash flow generation, high return on invested capital, and now they do more buybacks. I know there is some SBC event happening in Google, so they pay employees with stock options, so that dilutes everybody. So they do some buybacks and then some dilutions, and at the end of the day, that doesn't change much. But overall, the quality of the business is so high that I like it. I like it, and the stock is trading at a PE of 24 right now, so it has rebounded a little bit. I bought it when it was low, like 150 here. Yeah, so I like it, and that's very, very good. I would argue to not have a 3% position in Google. This is such a safe bet that it could be good. And actually this week we will have a regulatory conclusion. Maybe they will have some action against Google, so you have to monitor this kind of situation. Okay, next one is Lululemon Athletica. Like every person on Twitter, you like Lulu, which is normal. The company is good. They sell sportswear, equipment, leggings. I'm not into this industry, so I have not done a lot of due diligence, but this is one of the worst performance of the S&P 500. Over the past 5 years, you see zero performance. Over the past 10 years, this is the chart. So the growth has been here, but now they have been destroyed recently. Market cap is 30 billion. This is a company that sells athletic apparel, footwear, accessories for women, men, and girls. Pants, shorts, tops, jackets for leisure and athletic activities, yoga and running. Yep, okay, so this is some yoga stuff, pants for women mostly. The margins are completely decent. The valuation is a P of 20, so not expensive but not cheap. That means even after the big drop here, the stock is not cheap. Okay. And what about the financials? You see some good growth of revenue. What about net income? Up and to the right. The balance sheet, they have more cash than debt, which is very good. And what about the free cash flow? Yeah, generating some good free cash flow. Return on invested capital is around 30%, which is good. They do some buybacks here and there. That's good. That's a very decent peak, financially speaking. My question to you is, what caused the decline in stock price? Is it a lack of growth, like bad guidance? Is it because of China, because they say a lot of stuff in China? Is it because a change in CEO? It is because of competition? Is it because of higher inflationary pressures for costs, so lower profitability, lower margins? Is it because of I don't know. There are many questions to be asked for this company, and they did massive buybacks. They increased buyback, so the management thinks that the stock is cheap right now. And growing debt pile, decreasing cash. Okay. Yeah, I leave this page with more questions than before, so that's strange, and that's way out of my circular competence, so I have no opinion. I just say that I will not buy this one. I don't wear yoga pants, so I'm sorry, I'm not your prime customer, so I will not have a strong opinion on Lululemon. So good luck with that, but you have some questions if you want to go deeper on your analysis. But I don't like it personally. Okay, now Celsius Holding. I know this very well. This is a company that sells energy drinks like Red Bull, Monster, and before it was a company, I think that their marketing stuff, like it was a drink that can reduce weight. So if you want to lose some weight, you drink Celsius. That's good for your health. And after this, they removed it from their annual report, so it's just a normal energy drink. So it's a normal energy drink. And like every person on Twitter, everybody owns it. And it was a darling. It was a spectacular business model, a vision. It will be the next Monster, the next Coca-Cola. And over the past few months, the stock has been crushed. They went up and up and up and up and up until they didn't. And the stock went from 100 to 30. So that's a minus 70%. And everybody that bought the stock along the way got absolutely crushed, destroyed. The market cap is $7 billion. It is a small cap, mid cap, small cap. And this is a beverage market. Yeah, this is, in terms of market share, the market share is way lower than Red Bull and Monster. So this is a smaller company that is growing fast. but it's a small company. And the margins, gross margin at 50%, net margin here. But I've analyzed it before, and they only have been profitable for 1 year. If you look at the 10-year track record, this is revenue, spectacular, exponential. This is net income, horrible. You have nothing, and just they have been making a lot of money just last year. That's it. And on a quarterly basis, yeah, now they generate some net income. I don't know if this is a long enough track record to estimate, okay, the company will be profitable in the next 3 years, 5 years, 10 years. I don't know, and that's a no-go for me. So it's a 0 out of 10 for me. I will not buy this business because they have been profitable only for 1 year or 2 years. So the lack of track record is horrible for me. So in terms of balance sheet, they don't have much debt. They have a lot of cash. That's good. And they have been generated cash flow only for 1 year or 2 years. That's too short. So I don't like it at all, actually. And you can say whatever about the valuation, about the growth prospects, about the revenue growth, about the scale, about the new products, about the market share. They have a partnership with PepsiCo right now, so it will boost distributions, exactly like Monster Beverage did with Coca-Cola in 2015, I think. So yeah, that helped them to associate with the big boys, the big players, either Coca-Cola or PepsiCo. So they have potential, they have runway, they can go into international markets, but the lack of profitability, I don't like this at all. Monster Beverage has been profitable for years, for decades, every year. So this is not comparable to Monster Beverage. Celsius is a growth animal that has been unprofitable. Now profitability is very recent. I hope it rebounds and everybody is happy, because now everybody got destroyed and everybody lost a lot of money. So I wish them the best, but this is not my kind of investment at all. The lack of track record is horrible for me. So I don't like this at all. Good luck with that. But if you are an expert of distribution, beverage, that could be a fabulous bet, because this is a stock, if they continue to grow in the future, this is a stock that can double, triple very easily. Not for me, but good luck with that. So I don't like this at all. It's a 0 out of 10 for me. Okay, next one is BP. Is that British Petroleum? BP. This is an English British company that sells oil. Market cap is 100 billion, so that's large. Okay, integrated oil and gas industry company. Okay. Yes, okay, so oil and gas company in the UK. Why did you buy Oxy and BP? Is it because you want some British exposure? Is it because you think the assets are better for one of these company? If it is it because one of your friend recommended BP? Why is that so? I mean, just invest in the best one, or the best ones are ExxonMobil, Chevron. That could be something. In France, we have Total Energy. These are the best ones. I'm not sure about BP. Actually, I have done zero due diligence on BP, but what I see is like any other oil company, no growth, a lot of cyclicality, a lot of debt. Free cash flow generation is a mess, because that's very, very cyclical, and that depends on oil prices. Return on invested capital also is a mess. And now that the stock price is cheap, they do some heavy buybacks. And I believe they have a dividend, 5%. So 5% dividend yield plus 7% shareholder yield. You have like something like 12, let's say 10% yield. Okay, that's what you can expect, 10%. Again, that's the equivalent of investing in the S&P 500, but if you invest in oil, you have 10% with a lot of stress, with a lot of uncertainties, wars, stuff, geopolitical mess, and you have some big volatility. So either you get a safe 10% with S&P 500 or Berkshire Hathaway, or you have a 10%, but that's very stressful. And in terms of stock performance, I don't know if you are very happy with that. Also consider this. Free advice for you, Abersa. If you have a lot of dividends, like a 5% dividend yield, you will be taxed on these dividends. And that's not the same thing to have 5% dividend yield and get 5% in your pocket, and 5% of shareholder yield based on stock appreciation. On stock appreciation, you are not taxed. For dividends, you are taxed. So you have to pay the taxes and then reinvest it. So if you had to choose between the two, I would always recommend to invest in stocks that don't pay dividends and they reinvest everything so that stock appreciation is great. That's the reason why I don't like dividends much, why I prefer buybacks and a return on investment or reinvestment in the business. So I don't like BP at all actually. I have a small position in Oxy because I'm a hardcore fan of Buffett. That's a small position. We are talking about 5%, maybe less than 5% of my portfolio. But BP, I don't like this at all. This is a 1 out of 10. Maybe the business will be here in 5 years, 10 years, but I don't like this at all. Okay, now next one is Kering. Kering, that's a 1% position. How many positions do you have? 17. Okay, let's do a shallow analysis of the remaining ones because this is smaller position. Kering is a luxury company that is less luxury than LVMH, less luxury than Hermes, and in France that's the worst one. So I completely understand why nobody wants to invest in Kering. The stock price has been going nowhere for the past 10 years. They have Balenciaga, McQueen, it's not even famous. Saint Laurent, that's not as luxury as Louis Vuitton. Margins are okay, price is cheaper, almost no growth. You have 3 billion of net income compared to a market cap of 30 billion, so P ratio of 10, something like this, and they have a lot of debt. Enterprise value is 50 billion, a lot of debt. And the return on invested capital is around 10, 15. They do some buybacks, cash flow generation. I mean, why would you invest in Kering when you have LVMH as a P of 23? Why would you invest in this one instead of the other one? I don't understand. I don't understand at all. I don't like this at all. I will not invest in Kering. It is cheap. It is cheap for a reason. It has dropped. It has dropped for a reason. This is some poorer quality of a business if you compare to LVMH. So yes, it's cheaper, but the assets are cheaper. The sustainability of the brand is poorer. So no, that's a 0 out of 10. Literally, I don't like this at all. I would recommend to stay with the best, especially in the luxury industry. I mean, why would you invest in other car companies in the luxury space when you have Ferrari? Just invest in Ferrari. The Aston Martin, Lamborghini, or the Porsche. If you compare the investment thesis, Ferrari is much more simple. So same thing for the luxury. If you are not an expert of the luxury space, invest in the best one. That would, especially if they have a low valuation, both of them. Okay, now the next one is Super Micro Computer with a 1% allocation. SMCI, very famous bet. I'm sure you are all aware of it. What is SMCI? SMCI. And this is a pure AI bet. I have zero exposure to this AI chip industry because of lack of understanding. This goes too fast for me, and I don't know at all if Super Micro Computer will be here in 3 years, 5 years. The stock price is completely a bubble, and this has been driven by good AI trend, good fundamentals, but I would not invest in this one because of the hype. Data centers, cloud computing, and a short report was issued against this company saying that it was a fraud, accounting fraud regarding the clients and the revenue recognition, and the stock price has decreased a lot. And yeah, everyone that bought during the bubble got crushed, like always. And if you look at the financials for the company, you see some great growth in revenue. So that's what you want to see. That's even stronger than expected. For net income, that's exponential. Nobody knows if this exponential stuff will continue. This exponential trend will continue. This is not a sustainable business that has been growing exponentially for years. This is very, very recent. So if this is a bubble, it will crash. If this is not a bubble and AI is the future, it will continue to grow. But nobody knows, and I surely don't know, so I would not invest in this one. They have a lot of debt. They don't generate much cash flow. I think they reinvest everything they have. Okay. Return on investment is 30%, but much cyclical. They issue some stocks. I don't like this one. I mean, the business is good. That's the future. But I would prioritize always businesses with a proven track record where you know exactly where the business will be in 3 years, in 5 years. You want to forecast. We are a business of forecasting. We are stock pickers and we want to invest in safe bets. We are dead sure there will be better in 5 years, 10 years. So this is not in the same category. This is not, that does not fall in this category at all. Okay, next one. Next one is Intel. Intel, what a disaster. What a disaster. I don't like the company at all. They are getting eaten by competition. They have changed the CEO 3 times in a very short period of time. They are doing some revamps of their operations. They are getting acquired by Qualcomm maybe because they are in such a bad situation. They are getting helped by the US government. So that means a lot. If you are not strong enough, you need the US government to help you out. So that's a complete mess. I would not touch this stock. I know it's cheap, but I would not touch it. That's a 0 out of 10. I don't like this at all. Operations are terrible. Revenue is decreasing. Net income is decreasing. They have a lot of debt that is growing. Debt, more debt, more debt, more debt. No return on invested capital because they have been crushed by competition. That's a complete mess. That's a complete value trap in my opinion. That could be cheap, but if the business is getting poorer and poorer and poorer, it will get cheaper and cheaper and cheaper. And the stock price will drop, drop, drop. So I will not touch this stock if I were you. And this is a complete value trap in my opinion. So yeah, this is what I tell to my students. The goal is not to make as much money as possible, but is to not lose a lot of money. Is to avoid these traps. So Intel, no, it's a 0 out of 10. And I would tell my students, don't touch the stock. Don't touch the stock at all. You can get destroyed on this one. And if it's a bet on a garbage stock. It's not a garbage company. It's a company that is suffering. But in terms of stock fundamentals, especially if you have 1 year of expertise in stocks, it's a very, very difficult situation, especially if you don't have any expertise in the chip industry. If you are an expert in chips, yes, that could be something and a spectacular return. But I don't know if you are, and I suppose most people are not experts in chip industry, so I will not touch, and I think that's a pure value trap here. Yeah, that's it. But that's it. That's what I would tell any of my students. Avoid the value traps. There are signs. If the business is deteriorating, less revenue, less net income, and it has been the case for years and years and years. If they change the CEO 3 times and they hire salesman, make like a salesman as a CEO, that I don't think that's a very good idea, because you want to see what it is numbers driven, KPIs driven, with a clear vision. You don't want to hire a salesman. So I don't completely disagree on the choices made by Intel, and the fact that they are getting help by the government is not a good green flag at all. That's not a good sign at all. That's a sign of suffering. So I don't want to invest in businesses that suffer. That's a 0 out of 10. That's a 0 out of 10. Micron, also a chip. Maybe you have some expertise in chips, or you are making a lot of bets on the chip industry. So they sell chips with a special niche. There are 3 players. You have Micron, Hynix, and Samsung. So Korean or Japanese. Anyway, Samsung is Korean. I don't know about the other one. And this is very cyclical. This is a good company. I know Monish Pabrai, Guy Spear invested in this one. Lilu, but they sold. And yeah, also this is a bet on chips, on AI. If you are an expert on chips and AI, that could be a good bet. But the cyclicality will destroy your sleep, because that could be very stressful. So yeah, that's a complete mess. To analyze this business, you need to clearly understand your products and the future of this industry. But financially wise, net income is a mess. No clear path for this one. They have a lot of debt. They don't generate much cash flow. They reinvest everything, and the return on investment could be a mess. So that's not an easy bet at all. That was cheap here when the stock was trading at around $50, and I've heard some good investment pitch at this moment are at $50 per share, but now at 100, that's a different story. The market cap is 100 billion, so that's a big company. I would not advise to look at it. I mean, if you are an expert in any industry, whatever, I don't know what your job is, just stay in your lane. That's stay in your industry where you are the expert and you know more about more in this industry than other people. So yeah, and that's something relatable for everybody. If you are an expert in a niche, just focus on this niche. That's how you will make money. That's how you will make money. Use the products that you use every day. Invest in the products and the services that you use every day, that you know really well. I know Monster, Beverage. I've been a gamer for years. I know exactly the feeling of going to a store. You have video games playing all night long. You only buy Monster or Red Bull. You don't care about the other one, the other beverage energy drinks. You have the two players. That's it. So yeah, just know your stuff. Know your stuff. That's I mean, I don't like Micron at this level. That's a 3 out of 10 score for me. That could be a value trap. I'm not sure about this one, but I just don't like it at all. Okay, now Stellantis, and now you have 2 shares of Stellantis. That's in the US, and that's Milan. That's from Italy. Why do you have 2 shares? What? Okay, same question for you. Why do you own 2 kind of shares or out of 2 stock listings of Stellantis? You want to pay 2 transaction fees? You like to pay transaction fees to eToro? 2 shares of Stellantis, you only need 1. I mean, the stock price will follow. You don't have much currency risk here. I don't know if that's done on purpose, but just so you know, you own 2 different shares of Stellantis. Stellantis experiences some big temporary problems regarding inventory. They sell cars in the US. They have Jeep, for example, and the stock has been very volatile. That's a cyclical industry, up and down, up and down. And 6 months ago, everybody was happy. The stock was trading at $30 per share. It was some excellent business, well-run, disciplined, cost-cutting measure. The CEO is the best. And now the stock price has dropped with some temporary issues, and everybody is insulting the stock, saying they are very bad, the brands are bad, etc. So that's a very cyclical industry, a hated industry at the moment, but they have some good brands in my opinion. I also own Stellantis. Not a small position in my portfolio, but I own some. They have some good balance sheet with good cash. The growth is a mess, but they have some good margins from the low growth. They produce a lot of free cash flow, and they do some buybacks here and there. And they have a 12% dividend yield. You know I don't like buybacks, but 12% is good. So I take the 12%. And yeah, that's it. I like it, and the valuation is quite low. The value don't also another mistake, another trap to not fall into for you is to not look at the PE ratio of 3 as extraordinary cheap, because this is a cyclical industry and earnings will decrease. So if you have a PE ratio of 3, that's price divided by earnings. If the earnings for next year are cut in half, that's not a PE ratio of 3, that's a PE ratio of 6. And if they are cut by a little bit more, you have a PE of 8. And in the car industry, in the auto industry, the average PE ratio is not 20. The average PE ratio is between 5 and 10. So if it's a PE ratio of 6 and Stellantis earnings are cut in half, so PE of 6, this is not cheap compared to the industry. So this is not absolutely cheap. This is not some crazy situation. This is a little bit cheap, rather cheap I would say, but don't get excited over the cheapness. But I like it. That's a very good bet. But check why do you own 2 kind of stocks here. That's a mess. Now Bitcoin Cash. It's a pass for me. I don't like. I'm such a Warren Buffett fan. I would not put 1 cent in crypto. So I have no opinion on this one. I don't like it. I will not put $1 in crypto. I don't care about the kind of crypto it is. I will not touch it. And Monster Beverage, well, we talked about Monster Beverage before. I like it a lot. I think valuation is high. Monster Beverage. This company has been here for more than 30 years. Is implemented in a lot of countries, a lot of good brands, and this is a very simple business that sells drinks, cans of different colors, different tastes, but they sell the same kind of energy drinks. The market cap is 50 billion. They have been profitable for years and years and years. Look at the graph here. All you see is green. Revenue, net income going up and to the right. We are not talking about Celsius holdings. We are not talking about exceptional growth, but we are talking about consistent long-term growth with a lot of free cash flow generation. This is exactly the kind of business I love. And they have absolutely no debt. They have a lot of cash and more cash every year. Okay, the return on invested capital is 30%, which is great. And they do some buybacks here and there. That's it. End of the business pitch. So that's some spectacular business. And I think this business will improve over the next 5 years, 10 years with more cans, more volume, more pricing. The PE ratio is 30. So quite expensive in my opinion. If it was at 25 or lower, I would maybe buy a position, open a position. And that's it. I mean, the stock price decreased a little bit this year from $60 to 45. So that's what, minus 25%. But the P ratio was still a bit expensive for me. So I wanted it to buy lower, but it didn't go lower. So I didn't buy at all. I didn't pull the trigger. But I like Monster Beverage a lot. So that's a good bet for me. A bit expensive, but if you invest for the long term, I think you will be handsomely rewarded. And the next one is a very small position, SQM. SQM. Sociedad Química y Minera. What a mess. I don't know this company at all. In Chile, you say? Let's see. That's the first time I see this company. Market cap of $10 billion. They have some debt. What do they do? Commodities producer, lithium, specialty in standard potassium fertilizers. It's just out of my circle of competence. It's a pass. It's a 0 out of 10 for me. I have no intention of buying this one. Okay. Let's check the financials. I mean, they don't lie. Wow. Revenue is a mess. Absolutely no growth. And just during COVID, they made some money. Net income, no growth at all. And then for 2 years, a lot of growth. So unpredictable. You can't have more unpredictable than this. What about the cash and debt? They have some debt. Nothing crazy. They have a net debt of $2 billion. So market cap is, $12 billion. Enterprise value, so included debt, $14 billion. So okay, balance sheet is leveraged, but that's okay. What about the free cash flow generation? It's a complete mess. I don't like this at all. Return on invested capital, complete mess. I don't like this at all. And the valuation is quite high. Yeah, okay. No, I don't like this at all. That's a 0. And that's linked to commodities. For a commodity that I don't understand at all. I don't know the price of lithium. I don't know the evolution of lithium. I would not invest in companies with a commodity that I don't understand. And I think that's it. What is strange is that you have a lot of cash in your balance. So here is another tip. Invest the rest of your cash, because you never know if you will have a bull market or bear market for the next 5 years. You never know where the S&P 500 will be in the next 5 years. So just ride the wave would be my opinion, especially if you have 1 year of experience in the market. If you are a beginner, trust the US markets. And if you are a beginner, you can allocate more cash. And there was a study made by Rob Vinal saying that if you expect a recession event like 2008 happen, if you think it will happen before 5 years, it's good to have some cash. But if you think this event of 2008 big crashes will occur after 5 years, it's pointless to own some cash. That's the big summary. But so if you think we are headed to a strong recession, that's smart to hold some cash, but 60% is a lot. So I would say, invest in more companies. So that's it. I like a few of your positions in your portfolio, Evolution, Google, but for a lot of your positions, actually, I don't like them at all. And I think that will give you a lot of unpredictable results for the next few years and a lot of stress. So yeah, I hope that's helpful and you will use these recommendations to improve your stock portfolio, to improve your stock returns. And if you want me to review personally your portfolio, improve your stock process, your method, how to invest stocks properly, I have an investing coaching program. This is the first link in description. You will have all the information you need, and you can book a free call with me so that we review your situation, your finances, your portfolio, and we take it from there and we improve it. So that's completely for free. Just check the first link in the description below. Okay, have a good day.